In this video, we're going to discuss the potential price upside for Bitcoin following a spot ETF approval. What do we think that Bitcoin is going to do? And we're going to look at Standard Charter's research on exactly this. Not only are we going to do that, but we're also going to look at what's the potential for Coinbase and how does that differ from, well, Bitcoin. Well, let's go ahead and start with the price projection from Standard Charter for Bitcoin. They see substantial price upside upon the approval of a Bitcoin ETF. However, it could take some time, so it might not be an immediate upside. They do, though, they see this as a watershed moment for normalizing Bitcoin participation by institutional money, and we expect approval to drive significant inflows and the price of Bitcoin. Now, we'll talk about exactly how long and price in that, but let's understand for a moment, Coinbase already represents a lot of institutional flow as well as companies like Binance for Bitcoin trading. So I personally do think it's very exciting that they mention, hey, we could get even more institutionals involved because we've already got a ton of trading firms and hedge funds involved in trading Bitcoin. In fact, think about this, over 90% of the revenues that, let me put it this way, over 95% of the trading activity on Coinbase is institutional, but over 95% of the revenue at Coinbase from trading comes from retail. So in other words, wait, like what? Institutions are already trading a lot. It's just retail's getting ripped off. If you're trading a lot, remember there are like institutional pro accounts you can sign up for at places like Coinbase and lower your fees a lot. But anyway, that's how Coinbase makes a lot of money, so Coinbase might not want that advertised too much, but oh well. So what do they say here? Well, Standard Charter compares Bitcoin and the Bitcoin approval to the first gold-based exchange-traded product. And they argue that after the first gold-based exchange-traded product was approved in November of 2024 here, the price of gold rose 4.3x in the next 7 to 8 years. Now, I think it's worth adding some context to that 7 to 8 years. If we had an approval in 2004, well, what happened in the next 8 years? Well, just 4 years later, you got the Great Recession, which crushed everybody's impression of how important real estate or stock exposure was, and a lot of people flocked to gold. So there is a counter argument here that 7 to 8 years after the ETP holdings matured, so to speak, could have been driven by the Great Recession and a flight to gold. No, they don't actually mention that in their analysis here, so I'm a little bit disappointed by Standard Charter, I have to say. This is their global research piece here. The fact that they didn't mention that as a potential reason driving investments into gold surprised me. Keep in mind also that gold is substantially harder to hold, like physically hold, than Bitcoin. Any of us can hold crypto on our own hardware wallet at home right now, and hopefully you have copies of it and you don't lose hundreds of millions of dollars of it in a dumpster, or you forget your password and you've got a few tries left before it all self-encrypts and you lose access to it. Hopefully you're being smart about how you're self-custodying crypto, but let's just put it this way. It's a lot easier, depending on how much you want to buy, it's a lot easier to self-store a USB drive than it is a lot of gold. Yes, I know we could throw a few coins into one safe, but let's also be real. You can't make copies of that gold, right? So you could have multiple USB drives, safety deposit box, home, another location, parents' homes, friends' homes, safety deposit box in Switzerland, whatever, right? Like you can self-custody your own cryptocurrency very easily, but gold is very difficult. Travel across borders with it, over $10,000 in value, you get in trouble, you potentially get it seized. It's heavy, it's dangerous to store, it's very subject to theft. There are a lot of problems with gold that you can avoid with Bitcoin. And so the reason I make that argument is it's also a little bit of a counter argument that maybe one of the reasons so much money flowed into a gold exchange traded product, ETF basically, is because it was so much easier now to access gold, whereas really, how much easier is it becoming now to trade Bitcoin? Arguably slightly easier. You can swipe up on Robinhood, which, wow, you've kind of been able to do that. So somebody else is still custodying your coins. It's still not your keys, not your crypto. The only difference now is when you have an ETF approved, you actually get SIPC insurance, which is SIPC insurance, covering your Bitcoin investment, right? So that's good. So we like that, because now if your brokerage gets, goes kaput or whatever, you have a claim to be able to get some of your money back. Remember, you get coverage of up to $500,000 on security. So let's say you're all in Bitcoin and it's all in an ETF. You actually have insurance in case that broker goes bankrupt, which was not true during the days, of course, of FTX, for example. Okay, so to gauge how big of a driver it might be, they compare to the previous ETP. Now, they also calculate how many Bitcoin they think will need to be created to sit to basically underlie ETF shares. They don't counterbalance this, though, with how many Bitcoin are going to go from existing, like how much existing demand there is that is now going to move to the ETF. Now, that's a little complicated, so I'm just going to draw that out a little bit. Because, again, I'm a little weirded out that, I'd like to just be able to shout out, like, hey, it's going to go 4.3x, but, like, some of the mitigating factors here, I don't think they really mention. So we can easily make the argument like they did here that, look, we're going to need to create at least or have access to 400,000 Bitcoin very quickly to underlie all of the ETF products that come out with a BTC approval. Okay, well, so multiply that by, the $45,000 we're trading at right now. And so that gets us, obviously, a very, very long number that I have to pause here for a moment and just put a bunch of commas between. It looks like we're in the billions. Yeah, we're at $18 billion. So that's $18 billion. That's, probably on the relatively low side for ETF inflows. But the point is, if the ETF demand, let's go extreme, okay? It is possible that $18 billion of Bitcoin goes from just trading on the chain to going 100% to the ETF shares, which basically mean that 400K will just sit at, Coinbase or whatever, and the ETF shares get traded. So the same 400K just goes somewhere else because the trading volume goes to the ETF as opposed to like the actual Bitcoin blockchain. So understand for a moment how that would look. Okay, so let's say you're, for example, an ETF provider, okay? You're going to make your own ETF. So we're going to say this is the subscriber ETF, and this is your own ETF, and you have $18 billion, and you're like, yeah, we're gonna put this $18 billion onto a hardware wallet, and we're going to be known as the custodian. Custodian just means you're looking after something, kind of like a custodian at a school. They look after something. You're looking after, in this case, with a Bitcoin on a hardware wallet, and presumably you have insurance. There's SIPC insurance. Not on this. The SIPC insurance isn't on this custody right here. But what is it actually on? Well, it's on these like fake shares that are created. There's this ETF process called create and redeem. And basically they just create shares out of thin air. Let's call it the S. Well, that sounds like short, so we'll call it the sub-B. There we go. The subscriber Bitcoin ETF shares, right? So that's your ticker symbol. And then if you have $18 billion of Bitcoin, let's say your shares are trading for $18 billion a share, well, then you have 18 shares outstanding at at $1 billion. Okay? So you just created paper, basically, to represent what is on that hardware wallet. And then these shares can be traded freely on like Interactive Brokers or, whatever, TD Ameritrade, Fidelity, whatever. So this is really interesting because this part is what's SIPC insured, not the underlying, though of course that is expected to have its own stringent requirements and underlying requirements and so on and so forth. Okay, good. So now the argument here is Standard Chartered says, oh, we're going to need so much more Bitcoin to actually support these ETFs. And as a result, they compare to that 4.3x we got with gold. Oh, and also remember, in the 15 minutes after Bitcoin's ETF was first approved, We saw it rise and then drop about $700 from where it was before the hacked release of the Bitcoin ETF. Based on the SEC's Twitter account being hacked, whatever. Okay, we're not going to make a video here about whether it was hacked or not. It could have been BS. It could have been to sample what would happen with the market. It could have been insiders. It could have been a whole lot of BS. Okay, it doesn't really matter. But the point is, price actually went down $700 net after, in that 15 minutes after the leak, before the SEC said it was a hack. And then prices just sort of stabilized again. So really weird. But watch Coinbase. I think Coinbase's stock is going to go down. We'll explain why in this video. But it is possible a lot of that same demand just goes to ETF shares, and then you actually don't have demand for the Bitcoin on the blockchain, right? Keep that in mind. When you're trading these shares, you're either trading here, which is the underlying Bitcoin on blockchain, or you're trading here, which is not on the chain, right? This is not on chain. This would be when it moves, which when it's custodied, it might never move. This would be, on chain. Okay, great. So Standard Chartered basically says we could go up as high as 4.3x, but let's keep going here to sort of their bottom line. So their more base case is that we'll probably end up seeing a 2.3x up to a 4x during the year that a Bitcoin ETF is approved, if it's similar to gold. I personally think there's some mitigating circumstances to that. So I do think we could agree with them, drive institutional demand, but I think they're a little bit bullish, maybe a little bit too bullish on how quickly Bitcoin might move in the first year. Now, the good news is you've got the halving this year, so that could help as well. Last time we had that, though, stimulus checks were flowing, so there's a question, are we going to have as much excitement and euphoria as we did in 2020 now? Who knows? Anything can happen. Of course, we could also look at the prior halvings, and hey, price did fantastically after those, so that's bullish. I'm simply comparing to what Standard Chartered here is saying. I'm always a big fan of adding more perspective. Like I want to add perspective now about Coinbase. So Coinbase is really exciting. This is an interesting one. Keep in mind, I have this website, ehack.com, where I throw my research on, and you could just Command F and go to Coinbase and you'll see it. But what I throw this here for free. This is different from like the courses on building your wealth at meetkevin.com. That's where I teach you entrepreneurship, how to avoid paying taxes, real estate investing, stock investing, everything that I know about building businesses, building companies. Those are the courses at meetkevin.com. Most popular one right now is the Gold course, which includes the course member live streams we do every morning the market is open. So what do we have here? Spot Bitcoin approval, likely within 5 days. I wrote this on January 5th. Okay, we already know that. That's old news. So Coinbase, though, I want to look at the Coinbase analysis quickly. And what'll actually help us with this Coinbase analysis is understanding the latest that we're getting with the price wars in the ETF space. Now, this is wild. The price wars right now, absolutely crazy. Everybody is lowering prices on these Bitcoin ETFs because everybody wants the custody. The idea is the quicker you get the custody, the better, the more money your company will be able to make. So for example, you've got ARK just lowered their fees. So they're in like a price war here. They just lowered their fees to 0.21. Bitwise lowered their fee to 0.20, undercutting ARK by literally 1 basis point. Both of them expect to use Coinbase as a custodian, and they'll actually have a fee waiver for 6 months or $1 billion of assets under management. So for a certain period of time, they won't charge any fee. And then you can see the other fees here range from 25 basis points all the way to 49 basis points. All of it a lot lower than that 1.5% that Grayscale Bitcoin Trust have. So this ETF is driving prices down massively and very, very, very quickly, which is fascinating. Okay, and I think that price war will continue. I honestly think these will end up being like zero fee products, which is probably what they should be. But anyway, so I think that, and we wrote this on eHack, and you can see all the details here, but basically I think you go to ehack.com, type Coinbase, right? But basically, I think that Bitcoin ETFs reduce Bitcoin trading volumes. I mentioned earlier that trading represents I didn't mention this part, but we talked about the institutional part. But anyway, trading represents 73% of Coinbase's revenues. Of that 73%, 29% represents is made up by Bitcoin. So using 2022 percentages, if 100% of Coinbase's trading went to an ETF, And then I multiply here $674 million of trading revenues times of revenues times 73% for trading times 29% for Bitcoin. Basically, $149 million of revenue would be lost per quarter. That's an annual loss of almost $500 million or just over. That would require, at about 10 basis points of custody fees, about $596 billion of Bitcoin ETF in custody at Coinbase to offset that loss. So in other words, I'm kind of bearish on Coinbase. Why? Because even though they might be custodying Bitcoin, I think they're going to make very little money on that Bitcoin. And that same race to the bottom that you're seeing in the actual ETFs, I think you're going to see here by Fidelity and Gemini as well. They want to beat up on Coinbase too and make them work for their money. So that means Coinbase could lose. And look, we know 100% of trading isn't going to go from Coinbase to the ETFs, right? That's obvious. We know that. But even if it's 50%, well, okay, still that's a lot. That would lead to a loss of over $60 million a quarter of potential revenues and of course, assuming the 94% multiplier here for retail customers. Even if you only assumed 50% of retail trades went to ETFs, it would still cost them $67 million a quarter. That's with just 50% going to the ETFs, right? And just assuming the retail trading goes over to the ETFs. That's a lot of money that they would have to custody just to offset the loss of Bitcoin trading. Because remember, going back to that picture that I made, anything that is traded as the share on the right side that's not on the chain, you have to be a licensed broker dealer. They call it a BD. You have to be a licensed broker dealer to be able to do those trades. So think Robinhood, TD Ameritrade, Fidelity, Schwab, whatever, right? When you're on chain, you could be Coinbase. But literally what we're doing here is creating a product that makes it less desirable for some people. A lot of people will still be on chain, but for some people to trade on chain, so they'll move over to the ease of trading at a brokerage. You know, Michael Saylor has called his company a proxy ETF, proxy Bitcoin ETF. He could also potentially see some outflows, but his company will probably mostly be valued at whatever the underlying Bitcoin they hold is, and so they'll have plenty of valuation left. So anyway, this is very interesting in my opinion. Hopefully you found this very helpful and interesting. If you did, consider sharing it, consider subscribing, and we'll see you in the next one. Thanks so much. Goodbye.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate an actively managed ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker.